What is PE? The PE ratio tells you how expensive a stock is compared to the money the company makes. Price. P equals what one share costs today. Earnings. E equals how much profit the company makes per share. Suppose Apple's stock price equals $200. Apple's earnings per share, EPS, equals $10. PE equals 200 divided by 10 equals 20. This means investors are paying $20 per share, $20 for every $1 of Apple's profit. High PE, say 40, equals people believe the company will grow a lot in the future, so they're willing to pay more today. Low PE, say 8, equals either the company is cheap, talks undervalued, or people don't expect much growth. In short, PE equals how many years of profits am I paying for if I buy this stock today? But here's the key point. If revenue and profit grow, the company earns more each year. That means the actual payback time is shorter than 20 years. If profits shrink, the payback time becomes longer. This PE is called the trailing PE because it measures the company's earnings from the past 12 months. Now that we've talked about trailing PE, let's move on to forward PE. Forward PE looks at a company's expected earnings in the future instead of just the past 12 months. It simply asks, how expensive is this stock based on what the company is expected to earn next year? Example with Apple. Apple's stock price is $200. Analysts expect Apple's earnings next year to be $12 per share. If we divide the price by the expected earnings, we get a forward PE of 16.7. That means investors are paying about $16.70 today for every $1 Apple is expected to earn next year. If you found this helpful, don't forget to subscribe to Data Bull for more simple finance explanations.